Ever wondered if there is a way to acquire property without navigating the often complex world of bank loans and strict credit requirements? What if the seller could actually act as your bank? Owner financing, often known as seller financing, involves the property seller directly lending the buyer the money for the purchase, effectively bypassing traditional mortgage lenders. The key steps typically include agreeing on the core terms, drafting a robust legal agreement, making an initial down payment, setting up regular installment payments, and finally, transferring the property title. This method operates by creating a private loan agreement directly between the buyer and the seller. It offers a level of flexibility that conventional banks often cannot provide. This arrangement can be particularly beneficial for buyers who might not qualify for traditional mortgages, and for sellers who wish to defer capital gains taxes or earn interest income over time. The process begins with thorough negotiation, where both parties must agree on the purchase price, the interest rate, the loan term, the amount of the down payment, and the specific payment schedule. This critical stage sets the foundation for the entire transaction, requiring clear communication and mutual understanding. Following negotiation, legal documentation is paramount. This involves drafting a promissory note, which outlines the loan terms, and a mortgage or deed of trust, which secures the seller's interest in the property. Engaging experienced real estate attorneys for both sides is highly recommended to ensure all legal requirements are met and the interests of both parties are protected. Next, the buyer makes the agreed-upon down payment directly to the seller. This upfront sum provides the seller with immediate capital and often serves as a good faith commitment from the buyer. After the down payment, the buyer begins making scheduled monthly payments to the seller, similar to a traditional mortgage, encompassing both principal and interest. Regarding the property title, it is common for the buyer to receive the deed to the property at closing, granting them ownership. However, the seller will retain a lien on the property until the loan is fully satisfied, providing security for their investment. Utilizing an independent third-party escrow service can help manage these payments and ensure proper documentation throughout the loan term, adding an extra layer of security and impartiality. A crucial aspect often overlooked is the importance of comprehensive due diligence for both buyer and seller. Buyers should still conduct thorough property inspections and title searches to uncover any potential issues. Similarly, sellers should verify the buyer's financial capacity and creditworthiness to ensure they can meet their payment obligations. Additionally, some owner financing structures might involve a land contract or contract for deed, where the seller retains the actual deed until the final payment is made, offering another variation of this flexible financing approach. Understanding these structured steps empowers both buyers and sellers to explore owner financing as a highly flexible and potentially advantageous path to real estate transactions. It provides a valuable alternative to conventional lending, fostering direct and mutually beneficial agreements that can open doors for property investment and wealth creation.